Welcome to Sentara Capital's Market Commentary, Federal Reserve Edition. I'm Will Allen. The Federal Reserve continues to dominate headlines following their announcement last Thursday that they would keep interest rates at near zero, a level they have been at for over 6 years. The fact that the Fed did not increase interest rates was not a big surprise, but the more dovish press release was, meaning they appear to be further away from increasing rates than they were in July. Recent global economic and market turmoil, China-related, along with still low inflation were the primary drivers behind the Fed's decision to leave rates unchanged. An important sentence in the statement released by the Federal Open Market Committee was, quote, "The committee anticipates that it will be appropriate to raise the target range for the federal funds rate when it has seen some further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term," end quote. That statement, very bland in comparison to other recent statements, does not sound like a Fed that's anxious to raise rates. This dovish tone took the market by surprise. You see, the two most likely scenarios from economists' perspective were either the Fed would raise rates but then be very clear that they had no plans for a second increase for quite some time, or the Fed would leave rates unchanged but then make clear that a rate hike in October or December was close to a done deal. When these two scenarios didn't play out, markets had to adjust. There are two markets where this adjustment was most evident. The first was the Chicago Mercantile Exchange, where Fed futures trade. Prior to the Fed's announcement of keeping rates unchanged, the odds of the Fed raising rates by December was at 64%. Since the announcement, those odds have fallen to just 41%. The second market adjustment of significance was in the U.S. Treasury market. Prior to the Fed announcement, the yield on a 2-year Treasury note was 0.8%. After the announcement, the yield on the 2-year Treasury fell to 0.68. That was the largest one-day drop in yields in over 5 years. Treasury yields fall when prices rise and vice versa. In the past, we have discussed the fact that the Fed has overestimated economic growth every year since the 2008 crisis. The Fed also projects what interest rates will be in the future. The blue line on this chart shows, as of 2014, where the Fed thought rates would be at the end of 2015, 16, and 17. The red line shows their reduced estimates as of this month. But take note of the orange line. The market believes rates will stay even lower than the Fed is projecting. In other words, the market thinks the Fed will continue to have excuses for why not to raise interest rates. So what could change in the next 1 to 3 months that the Fed could point to as a reason to move after staying put this month? Well, taking a look at the two issues the Fed raised as problematic for a rate increase, when we look at core PCE inflation, it's running at an annual rate of 1.4%, below the Fed's stated goal of 2%. With sluggish wage growth and falling oil and commodity prices, it's hard to see what will drive inflationary pressures in the next 3 months. The second issue the Fed raised, global economic uncertainty, mostly stemming from the impact of China's economic slowdown, this also doesn't seem to be an issue that can be resolved in just a few months. China's central planners are trying to shift their industrial economy to one driven by the Chinese consumer, similar to the U.S. economy. But this is a work in progress for the Chinese, and they are in the early stages of this transformation. Success is not a certainty. Looking at these factors, it is not hard to see why markets had to reprice future rate expectations on the heels of the latest Fed statement. Now, not all of the Federal Reserve Bank presidents believe rates should have remained unchanged. St. Louis Fed Governor James Bullard, who is not a voting member of Fed policy this year but does attend their meetings and is involved in discussion, came out in an interview this morning on CNBC and said, quote, "There's a powerful case to be made that it's time to raise interest rates. And the case is not complicated. Policy settings are in an emergency. The committee itself, the goals of the committee, have essentially been met. Even if rates go up, monetary policy will still be accommodative," he added. The committee has not, in my view, provided a satisfactory answer as to how near zero interest rates align with close to full employment and continued economic growth. Finally, Bullard said that rather than clarifying the Fed's direction, last week's decision seemed to increase uncertainty about the direction of the U.S. economy. We here at Sentara Capital believe uncertainty is playing a major role in the sluggish growth here in the U.S. Many businesses will now continue to be in wait-and-see mode as it relates to interest rates. Add this concern to a long list that includes tax policy, health insurance concerns, and a growing regulatory burden, and it's no surprise that many businesses are choosing to delay new projects or new hiring. The Fed had a chance to remove the first increase from that list, and it didn't take it. As such, the debate over when the Fed will raise is going to continue to be front and center. Thank you for watching.